we're really talking about here is market efficiency, and it's easier to make money in less efficient markets. And that's, something you learn in the first day of business school, really, in investing classes. It's really that you want to go where other people aren't, because if you do what everybody else is doing, by definition, you're going to get an average return, right?
You get an average return if you extend that, right? In a perfectly competitive market, what are profits? They're zero, right? So same way, there's no money to be made, right? There's no arbitrage, right? The arbitrage with you could be the information you know, right? But absolutely a great point. And I will always say this. Remember how I started out my conversation with you is, what are my capabilities? My capabilities are technology. So I felt like I had that upper edge against others when I was evaluating a technology company, because I could make a distinction of why I thought this company was better than that company, and where I thought the numbers were incorrectly being priced, or those cash flows being priced by the market. Because at the end of the day, when Apple opens up, it's trading at, I don't know what it's trading at today, let's call it 170, right? The market's telling you what they think of Apple's future cash flow. The question you have as an investor is, do I buy that stock today, or do I put my money somewhere else, right? And you have to bring that capability. Probably less capability to understand with Apple and their $410 billion sales versus you looking at venture companies and startup in different cycles of the stage of the startup, right? Trying to develop into a company like Apple.
And you just hit on another really important theme, which is develop an edge. Figure out what you're good at as an investor, and then go all in on that. And that's how, that's how smart money operates. They find people and institutions that have an edge in a certain area, and they allocate to them so they can make money off of that edge. And so that's another key theme. So if we're to summarize some of these key themes,
yep.
Look for inefficient markets, look for informational advantage, play to your strengths, figure out what you're good at on a relative basis. Think very, very hard about price and value. Yep. What are you paying for what you're getting? Right. Think very hard about relative value, which is related to price value, but that's incredibly important. And then look for Oh, go ahead.
You don't need to always run with the crowd, right? You can be a contrarian. Now, you don't need to be a contrarian just to be a contrarian, right? But understand that when you're running with the crowd, it only takes one to decide, I want to get out. And then everybody else starts to get out, and you could be left holding the bag. Understand why you're there. And if you're going to run with that, understand, right? Because we could all sit back and say, wow, we wish we would have ran with the crowd if we would have owned NVIDIA this year, right? When they basically doubled their market cap. So there's things like that, right? And understand I think it's a really big point that you make is understand, look, are you a growth guy? Are you a value guy? Are you a GARPy, a growth at a reasonable price? Understand who you are. And you could just say, I'm a momentum, I chase growth, and I understand that I could have risk there. That's okay too, right? You don't have to put your entire portfolio in one company. If one works and goes up 100%, the other all go down 10, still making money, So, yeah.
So I'll add to that. I think being forward-looking, as much as that seems obvious, most of the market's backward-looking.
Yes.
And so truly look ahead and think about what's changing and where are there going to be inflection points, where are there catalysts that are going to change the price or value of the securities that you're investing in. I think that's huge. People miss it all the time, even though it should be very obvious that you need to be forward-looking. People don't invest like that in practice.
Right. And I hear it all the time, right? Oh, why is this company down today? Classic example. Google down today, right? The numbers weren't that bad. No one cares about what happened yesterday. They're trying to decide what's going to happen with Google. If AI and cloud, the numbers weren't as growthy as people were expecting, that's a disappointment. That doesn't tell me anything about yesterday. It tells me about what investors are looking for in their future cash. This is what I always tell my students, right? Everybody always talks about stock prices. I don't care about the stock price. What I care about are the future cash flows of that company to determine what is the value of a business. I give them a great example. You're going to buy a rental property. The gentleman or the woman who wants to sell you the property is charging you $3 million. Sorry, $10 million. And the income is going to be on the $10 million is going to be, I don't know, a 5% return. And you're thinking, well, that could be a pretty decent return until you figure out that you could have just put your money in the bond market, give it to the government, and you could sleep at night with no risk in principal or interest, right? That's understanding where your capability is at. Maybe you are an investor in real estate, and also understanding what are those future cash flows, what are the risks of those future cash flows, and how do I tie that back to what do I pay for that company today? Very, very hard to do. And I'll make one more point, right? It's very hard to dig through the filings, the K's, the Q's, and the minutia that goes on in there. But those are the details that are going to what allow you to become a better what investor at understanding what could be the little details that could actually change, right, the valuation of a company. And I'll leave it with an example. Everyone's hyping Tesla from the standpoint of this growth in units, growth in units, growth in units. Yeah, it's fabulous. But if they continue to lower their prices, they should be able to grow the units, correct? The question becomes, is it profitable growth? Well, when your gross margins last year were 26%, and this year you're 17%, that's not good, because ultimately that's going to affect your net income. Well, now net income margins are 7.5%. And instead of looking at Tesla as a software growth company, why has the valuation come down? Because it may be really a car company.
Well, to tie that into what I'm doing in the private markets with startups, a lot of VCs will value companies at very, very high level without really having justification for that. And you have to do that. Don't get me wrong, because these companies are early stage and some of them are pre-revenue, and some of the companies have low revenue, but folks are extrapolating into the future, looking ahead, which is a good thing. But they oftentimes wind up overpaying quite a bit, right? And what's different about what we do at ARI is we lend money to companies that are early stage, but they're already generating revenue. And many of them will oftentimes be at profitability or close to it. And so we can actually value the company and get a sense for what's the intrinsic value of this company. And of course, the idea here is that these companies are growing very quickly, anywhere from 50% to 100% annually, sometimes more. And so, of course, that value is going to expand. At least that's our underlying assumption. But there's enough evidence and enough traction in terms of the revenue and the cash flows to say, okay, I know what this company is kind of worth, even if they don't reach their full potential. Like even if they stagnate or slow down in terms of growth, they're still going to be worth X. And that is enough for us to then lend to them. And they're going to generate enough revenue and cash flow to support the interest payments on the loan. So it's, so what I'm getting at here is that whether you're in the public markets or in the private markets, whether you're looking at mega cap late stage companies like an Apple or Google, or you're looking at seed stage or Series A or B company, it's still fundamentally the exact same thing that you're doing.
It is. That's a great point, Zach, right? You talked a little bit about edge. I call it capability. You bring capabilities, right? If I were to say, hey, Zach, you've been selling used cars for the last 20 years. You've been buying them from these dealers and you've been doing that. What you've been able to gather, and this goes even into the mom and pop world, right? I would always ask them questions. Why are you selling the business? Or why don't you keep? Well, my son or my daughter, they don't understand pricing, so they can't take over the business. There's a lot to be said about understanding a business model and understanding pricing. And in essence, what you've got a tough job, because I think as an analyst, I look at myself as a bottoms up, right? Look at the details from the bottom, and I don't have to worry about the macro as much, even though I'm aware of it. I also keep inflation. That's more of a macro thing, but I have to keep aware of it, right? Where you have to really understand how those things play, because you have these companies who haven't experienced anything just yet, right? I can go back in history and look at how does Apple do in a downfall, right? What happens to the business model? What happens to the margins? You have to build on that based on experience. What have you seen? And the more you see, the more different types of business models you see, the more you can assess what? Pricing basically leads to risk. And if you can become better at assessing the risk, you can become better at assessing what? Valuation. If you can become better at assessing valuation, you do what? Ultimately better than anybody else. You mitigate the risk. And if you can mitigate the risk, then your upside is much greater than your downside if you can get in right. Now, we're all not going to we all think we can make the greatest investments, and that's all we talk about, right? We never go into the bar and say, hey, I want to tell you about all my bad investments. I want to tell you how, hey, look at Microsoft's up today. Wow, I bought Microsoft last night. Okay. So these are the things we're looking at. But if we're true to ourselves, it's really understanding the risk. And I also attribute that to that when the wealth manager manager's calling you up to invest in a stock. He's never telling you about the stocks you should sell in your portfolio, so to speak. He's telling you about all the stocks that you should buy. So there is a bias. But the one thing you talk about when you talk about edge or capability is you see many of these companies over and over again. And you can see some of the mishaps. So when you're valuing that, you always would inject that into the possible risk.
Eddie, you bring up a point that I think is important, and it's really this idea of pattern recognition that enables one to then handicap probabilities. And some people will say to me, "Hey, you're pretty new to venture debt. Why should I invest in you?" And the response is, the truth is, I've seen more than probably anybody in this space because I've either traded or executed over 50 billion in debt deals. Right? Nobody in the space even comes close. So I've seen more business models and more successes and failures and worn risk for 24/7 for more years than almost anybody in this space. So people sometimes have a hard time comprehending that because they'll say, "Oh, well, did you do like this deal or that deal?" It's like, who cares about a deal? I've done like 1,000 transactions, thousands, right? And I've analyzed thousands of companies. And I've talked to thousands of business leaders that are CEOs, CFOs, hedge fund managers, portfolio managers, institutional allocators, right? And what that gives me, to your point, is it's this ability to basically compare and contrast, and it gives you a sense for where things are going, even if you don't know a lot about that particular company, or it's an industry that's nascent and nobody knows where it's going to go. So what do you have to do? You have to take everything up here in your mind, all the things that you've seen in the past, and develop a story for where you think this is going, and then be able to handicap that and pick probabilities for where things could wind up. And
that's a great point. You're tying everything, all that capability, and it could be qualitative. Like I tell my students, great to tell a qualitative story. How do I take all that capability and drill it down to, this is what this company is worth at the end of the day? The numbers, like I said, cash flows don't lie. Okay? And that's what you do best. And what you're taking is your capabilities, and you have a lot. You have a strong pedigree, you have a strong work environment, basically on what you experience. You're bringing those two together to do what? Make an assessment, right? You walk into a doctor who's operated on 50 arms or 1,000 shoulders. You know what? Been there, done that, have seen it, right? I can assess the risk first and foremost, and then I can do this procedure to make it better. And this is your upside. No difference in a business.
And two things you brought up there that I think are really important. One is think about risk first, right? And be trained in risk, not just say, "Hey, I think this might happen." What's your process for assessing the risk? And then the second step, which is even more or equally important, is how do you price it? But the reality is, my job for the last 15 years was pricing risk all day long, every day, all types of risk. I've priced corporate bonds, I've priced leverage loans, I've priced bank loans, I've priced preferred stock, I've priced hybrids, right? And so what that means is within any asset class that I'm looking at, within any product, I'm thinking about how to price the risk factors that I've assessed. So you first assess the risk factors, and then you figure out how to price them. And you're nodding your head, and for folks that are listening to this, this is the key. How do you price the risk? And I'll give you a great example. When folks were underwriting venture loans in 2021, I love venture debt. I'm probably the biggest advocate for this product in the country, right? But they were pricing them wrong. And so venture loans from 2021 that were priced at prime rate from Silicon Valley Bank, that's garbage. You might as well flush that. It's a terrible investment because prime rate was at 3.25%. So they were earning, and some of these loans were priced subprime. They were literally at 3%, 2 3/8. Terrible.
Yeah.
You are not getting paid for the risk you were taking. Now the market's changed. So now you get paid for that risk. And it's funny, I was at this conference, this venture debt conference in March in New York. And this is right after SVB had collapsed. SVB collapsed, I think it was March 10th. And this conference was March 31st in New York City. And people were like, oh, we don't know where pricing is going to go. I'm like, yeah, you don't, because you've never traded a multi-billion-dollar book. I know where pricing is going to go. It's going higher, right? And so a lot of people that stepped in to that market after SVB collapsed also are going to get the short end of the stick because they stepped in way too early. They stepped in when they thought they were going to go take market share. What they got was adverse selection. They got the companies that needed cash, right? That were no longer able to get it from SVB at 3%. Then going to the next dummy in line to get it at a little bit of a higher rate, right? And ultimately, those guys are going to have a lot of trouble.
Because in some cases, some people haven't even experienced risk, right? Some people didn't experience 2008, and those who experienced can see what a stock. Amazon went to like below $5, right? So it's just things like that unless you see it and experience it and almost feel a little bit of the pain, you get what? You don't get away from always trying to understand what is my downside first before I can figure my upside. Because the thing you and I can do every single day is we can give our government to the money to the government and sleep at night knowing we're going to have protection of principal and interest, right? The question now is looking at the government market, and this is what I tell my students every day you wake up, the day you get married, what is the yield curve telling you? Because then I'm going to be able to price risk off that yield curve and to ask myself, am I being compensated for incremental return that I'm receiving on any type of investment, even in your world of venture debt?
So, Eddie, it's funny. Most of the folks that have only been in the market for 15 years, they never saw the credit crisis, the GFC. And so when people say to me, hey, I have a great 10-year track record, my first thought is, who cares? If you didn't, you should go jump off a bridge, right? Because everybody in the last 13 or 15 years had a great track record.
Yeah.
Anybody post 2010. The market only went up and to the right for 10 years or 15 years.
NASDAQ, look at the S&P in the public markets, right? When you get rates going to zero, right? What do? You buy growth. It's not that hard. And the math will tell you that, right? Risk premiums, right? That's where you buy and you actually chase, right? It's in times like this that we could be possibly going into where now things are different. Why? The cost of capital is much higher.
So let's get into investment mistakes that you've seen others make. I touched on one, which is mispricing risk. You could have a great product or a great company, but you buy it at a price that's too high, or you lend to it at a rate that's too low. What are some other mistakes that you see, especially in innovation and technology?
I think one of the biggest mistakes from the public markets, right, and that's all I can speak to, is this is one that I see all the time is when the analysts on Wall Street start to model the company, they're very quick at modeling it up like a hockey stick because they're trying to get investors attracted. And they're very slow to take numbers down when things go bad. And I think one of the worst things that you can do is not understanding how bad things can get when they really get bad. And I always think that in any investment, you always have to do bull and bear case, okay? And you have to do what? Some sort of sensitivity analysis, understanding when it gets bad, how bad can this get? I'm going to give you a great example. There was a company called Tableau. And investors could go back and look at this company. They lost 50% of their value in the aftermarket. In the aftermarket. Real software company making money. Why? Because what people don't understand with a software company is they have very, very high gross margins, very, very high operating margins. But when the numbers go south, guess what happens? Those margins help you when things are good. Boy, they look ugly when things get ugly, right? Because those margins start to drop, and they drop like. So one of the biggest mistakes that we will do is get too caught up in, it's just up and to the right all the time because we haven't seen a bad market and how the models can change. That's number one. And I think another big mistake that investors will always do is they don't know when to get out of a company and sell, right? Because they get too infatuated with what the market is telling them, okay? And the market is telling you this is what I always say about investors. You're chasing price action, right? Every day we can see, and it makes us feel good when Amazon or Apple, for instance, goes from 90 to 110 to 120, and you're not assessing the risk of the company or what the cash flows are telling you. You're letting the price tell you, oh, wow, this thing can go to 200. Why? Because it keeps going up. And that's a big mistake. Every single day, a portfolio manager, hedge fund manager should always evaluate what are my opportunity costs? Where can I get a better investment than Apple? If Apple is the best investment because you own that, okay, then you keep it in the portfolio. But you keep it in the portfolio because there aren't other what? Better returns, maybe in that asset class, that can give you a higher return with less risk. Because if you only associate it with price, you're going to keep owning that. Tesla kept going up, kept going up, kept going up. 3 weeks ago, an analyst at Morgan Stanley, right? We all think the Wall Street analysts are really smart. Puts a strong buy recommendation on it. Stock gets up to 270, trading at 213 today. Why? Again, pricing is coming down, margins are coming down, and the prospects are worse. And then you'll hear analysts talking about, well, Elon Musk was negative on the conference call. If Elon Musk was negative and they had blown out the numbers and the margins were going the other way, no one would have cared. Ultimately, stocks reflect what their fundamentals are telling them. And what the fundamentals are telling you about Tesla is they're getting worse, not better. So those are I would say, from my public standpoint on companies, that's where I see big mistakes.
Yes, one thing you touched on there that's incredibly important is exit strategy. Mm-hmm. And it's different in the public and private markets because of differences in liquidity, of course. But ultimately, a lot of folks get into an investment, and it might be a great investment at that time, and it might perform really well. But when do you exit? I think about folks that were in crypto, and they bought in, before the peak, and it peaked at close to 70,000. Bitcoin did in a couple of years ago. When do you know? When do you know when it's time to sell? Is the question. And how do you think about exit?
Growth is very, very, very hard, right? You're always assessing the prospect. So if I get a small company like Tableau, who's in the business intelligence space, I try to assess what is the market opportunity, and realistically, what is the opportunity of that company within that, right? Because at the end of the day, when you're a small company, I would say, great opportunities where in many cases, even in your case, you fly underneath the radar. You start to become bigger, okay? And now the bigger guys start to focus, okay? And they start to say either we acquire you, could be an exit strategy, or we try to, make it difficult for you, right? And hurt your business prospects and your growth. So as I said, you're always looking at the opportunity of what is the opportunity of that company? Has it achieved what I think could be the best it can do in an environment with valuation and the business model? Do I stay there, or do I decide, you know what, I'm going to sell because I think it's reachable? Here's my thing, and this is what I tell my students. You always have to have a price target. And when it gets to that price target, here's what Wall Street will do. They'll just take it higher.
Yeah, they just move it.
They don't have any money at work. What you have to do is ask yourself at that point in time, just because that stock is green, does it make it what? A great stock or great valuation? Is there a better opportunity, right? In that sector, that's where you want to have your money. If not, then hold on to your investment. But if you don't be lazy and say, you know what, I don't know, I'm going to ride this horse. I never do that. I'm always looking for what is the opportunity. If I'm going to sell NVIDIA, where am I going to put my money? If I don't have that place to do it and I have to be invested there, I'm going to stick with my horse, so to speak, and I'm going to maybe let it ride from a standpoint of valuation, even though I think it's a little bit expensive, because I'm always looking for other opportunities. So my exit strategy is always basically having a target price. Target price comes from some sort of view on what I think the growth profits are in the free cash. How do I value?
In the private markets, in VC, it's a little bit easier in a sense because most folks are just going to buy and hold until there's an exit or an acquisition. Either they go public or they get bought. So that kind of becomes the obvious exit point. And for a lender like ARI, it's pretty easy too, because we have loans that have discrete timeframes. So we'll say, okay, we made a 3-year loan. At the end of 3 years, we don't have to continue to have anything to do with this company once they've repaid the loan. But if we choose to, we can reassess at that time and maybe continue to lend to them. So that it's a little bit easier for us. So you have it much harder in the public markets.
You've got a finite term, right?
Yes.
Look at it as having a finite term. I'm always looking at what are my opportunity costs, right? And do I stick with what my investments are, or do I find other investments that provide what? Greater value. And the greater value means I'm always looking at the cash flows. Is this company doing better than this company? Are they the same? I'm going to common size them. I'm going to make them look the same. Okay, why do I this one company at these levels, this valuation, and buy this company because I think the what? The future prospects are better cash flow. The one that I'm
saying. So segueing a bit in terms of technology companies and how they fund themselves, how do you think about debt as a piece of the financing puzzle, especially for earlier stage tech companies?
You know, I think it's interesting, right? Because traditional way I look at a company, right, is you go IPO, you raise money in the capital markets on the equity side, you're looking for owners of the business, so you're selling, and then slowly as you become a more mature company, right, where you can service the debt, right, okay, you start to add debt to the balance, right, because it's lower cost of capital. When it comes to your space, it becomes a little harder, right? Because I'm always, when I'm going to lend money and you're my buddy, and if I lend you $100, maybe I'll say, hey, what's the collateral here? If you don't pay me back after you go drinking, right? Well, $100 is probably not a big number, but think about lending $2 and $3 and $4 million. You're looking at what is the collateral? Where do I offset my risk? Again, is it, it's not equity. I'm not getting ownership, right? You're paying me some lower rate than I would get if I were equity shareholder. Okay, or owner in the business. So I would be looking at, okay, where can I mitigate my risk on some sort of collateral, whether it's I get some of your accounts receivables or I get a portion of your revenues. So I'm looking at other ways to mitigate that risk, right? Because the pricing, right, is not going to be like equity, right? So why do you make these great returns on a venture deal, right, when you take equity? Because there's a good possibility you're going to zero. Probably, and I don't know, there's probably a greater possibility in a venture deal, right, that you're going to zero than you are becoming the next Google, the next Amazon, or the next Microsoft, right? So those are the things that I would be looking at is where's my collateral? How much do I think I can get to offset the investment?
Yeah, that's a great point. I think part of the reason why venture lenders have traditionally done very well in terms of very, very low losses is that they typically are keeping the loan to enterprise value very low. Like the average in the industry amongst the better lenders is like 10 to 20% range. And so even if the company doesn't reach its full potential, there's still so much collateral and cushion essentially that it still protects the lender quite well. So that's one thing to consider.
Another round where there's another round coming and they're going to put more capital into the company. So that could be something to mitigate, offset the risk, because you got terms of 2 or 3 years, right? So that could also be.
And from a founder's perspective, so if you're the tech founder,
right,
tech company founder, how do you think about the decision between financing with equity and debt? And assume you're later stage, so you're generating revenue and you're profitable. How do you think about that decision?
I think about it. I hate giving away, ownership of my company, right? I hate giving away that upside. Okay, so that's very, very hard. I would hear stories of how, people will give up 30, 40, 50, 60%. I always hate giving up upside because I'm the founder. It's my hard, time and sweat and really rolling up my sleeves and getting into my business to build this. I hate giving that up. So if I can find other ways of trying to get cheaper capital, if that's the word, that's the right way, and it probably is, I would try to do that first before giving up ownership, right? Because think about it for investors. When you're giving up ownership, you're giving up claims to the future cash flow. So if I own 100% of the business and I made $1 million, I get to keep $1 million. But if I own 20 and I gave away 80, I only keep 20. I'm giving away 80, and all my hard-earned sweat and everything I'm putting in to give somebody 80% of the profits going forward. I only keep 20. That's hard, and that's in some cases could be demotivating.
Okay. I think you kind of nailed the biggest theme with founders, which is that they want to keep the companies that they've built. And I've read some academic research. I think it was Stanford or some professors from Stanford that did this research that basically showed that if companies that IPO that were venture backed, the ownership percentage that belongs to the original management team is something like 3 to 7%. I mean, you'd be amazed at how much of their equity they need to sell to get to that stage. And that's why I think venture debt's really catching on a lot now, because folks are starting to realize, wait a minute, there's alternatives to equity financing.
Yes.
And it's not right for every company. Oftentimes people will call me and they're way too early for debt. But once you've reached a stage where you've got sufficient revenue and cash flow to service the debt, it makes a lot of sense to have some debt in your capital structure, because to your point, it's cheaper. It's a much lower cost of capital. It's about a third to 50% of what you'd pay on the equity side for capital. And it's also much less dilutive. The lenders typically do get equity warrants. So there's a little bit of dilution to the founders, but not a lot. And so ultimately, you're going to own a lot more of that company if you use debt along the way. And your payout at the end is going to be significantly higher. And that's ultimately what appeals to founders, I think.
Companies are in different cycles, right? And you talked about it, maybe a little bit more mature where, you can see how they can service the debt, right? And it could be in a period of where they are in the business cycle. It could be in a period of where the economy is. There's so many things to look at, but you may have a good company, and as long as you can service debt. Great question. I'm going to tie that to the capital market, second, the public markets. Students ask me, why does Apple have so much debt, right? I should say so much. It's a big number. It's $132 billion. They generate all this cash. Why? There's so many reasons why Apple has debt on the balance sheet, because, and I tell them, when you generate a return on equity of 170%, you can borrow money at 3%. There's a good reason you should be borrowing money, right, to fund purposes of your company. Why would Apple bring money back from, Europe, bring money back from China if the money is there? Well, if they bring it back and they repatriate, they have to pay taxes. But if they want to pay a dividend and they want to buy back stock, why not borrow it? Someone's going to give you money at 3%, and you think the returns are better in the capital allocation of not bringing that money back, borrowing the money to do those two things. Not a bad idea. Last year, Apple spent $15 billion in dividends. They bought back $89 billion worth of stock. Okay? Part of that's financed. Okay? If I can borrow at 3%, not a bad idea. Not a bad idea. So again, always trying to think of ways and how to leverage your capital structure in the proper ways, right? That's not bad. It's not. If you're over levered, it could be a problem. But if you're using capital that is not giving up ownership and going into the debt markets where it's cheaper, and I know I'm using a great company, but that may be the way to go.
Eddie, you nailed it. Funny enough, when I was at Deutsche Bank as a bond trader, we led the biggest bond deal in history at the time, which was Apple's deal. And and the TMT trader that sat next to me was the lead trader on that deal. And it was great because the entire trading floor just paused, and everybody, rates traders, structured products, everybody just froze and was watching him trade these bonds on the break, as they say, at the end of the day. And the reason they did that big deal, there were a couple of reasons, but you already mentioned it. It was that they didn't want to repatriate a bunch of the cash that they had overseas. And it was so cheap for them to go and issue debt that they figured they'd do.
Yeah. But I think, again, it's smart and proper use of your capital structure, right? I talk to students about Apple's portfolio. They say Apple owns mortgages, Apple owns treasuries. Yeah. They're using their allocation, right? Or the capital structure and their cash, right? If they're spending on average about $10 billion in CapEx, what do you do with the excess cash, right? Well, I got to put it to work, okay? And if I don't want to put it to work because I can't put it to work in the company because I don't have any opportunities, then where is the next best place to manage my risk and achieve an incremental return above and beyond just having it in money market account?
So we've only got about 5 minutes left, and I wanted to ask you a big picture question. If you had to give advice to an institutional investor on how to invest in innovation and technology over the next 3 to 5 years, what advice would you give them?
My advice is, let's take AI, for instance, right? I was looking at some IDC numbers, the compound growth. I mean, you look at hardware, $37 billion going to $650 billion, software going from $1.5 billion to, $150 billion from now over the next 10 years. My biggest advice is, first and foremost, and I think everyone should understand this, do the detailed work. Don't get caught up in the hype. The hype needs to translate into the numbers, okay? I.e., we've got a great example that we didn't have back in 2000. NVIDIA showed you what a company can do with its cash flow. Its cash flows go from below 10 billion to probably 36 to 40 billion over the next 2 years. Okay, that's not hype. That's real. So try to always turn the hype into numbers. For you, and even for those investors, some of it may be difficult. Okay, so you may not want to put all your eggs in one basket, right? Because you may want to look at, right, multiple companies in multiple places. Okay, but stay away from the hype and get into really understanding what is the market. What are the so-called, right, strategists telling you about the market, the growth guys telling you about, and try to always ask yourself, are those reasonable numbers, right? Are those reasonable numbers? AI is going to be very big. Business intelligence is very big, okay? But even there was a lot of pitfalls, okay? And the issue is you got to understand also, like an investment, what's the upside, what's the downside? A lot easier said than done. And you're going to miss a lot of great companies. But just because you missed great companies, i.e., I missed Walmart, I missed Home Depot, I didn't buy them, doesn't mean that you got to go out and try to find them in the sense that I just got to throw money at everything and hope that they're going to become the next Walmart. Very, very.
Great points. Anything else you want to add before we go?
No, I think that I will say this. I think AI is going to be very, very, very big. What people need to understand is, and I associate this with any investment, but if we think about what AI is, it's intelligence, right, Zach? It's intelligence. Who has the data to create intelligence? Big corporations. They just going to allow that lady to go out there and be out there for free. It's going to be very, very hard. So is there, though AI is going to be phenomenal, is there some sort of cap? You know, let's not get too crazy about it. I said this in business intelligence, right? There's so many disparate areas of data. Bringing that together is very, very, very time consuming, hard, and costs a lot of money. Microsoft talking about chips that they have to buy from NVIDIA. Expensive. Understand that. It's cost to everything. Okay? Make sure that the return greater than the cost any investment that you
I agree with you. I think the way to play pure AI is to stick with the big incumbents that have the data and have basically infinite resources.
Yes.
Like the Microsofts of the world, for instance. You can't beat them in terms of what they're doing. So find a different game to play. And so what I'm looking for are companies that are utilizing what folks like Microsoft are building to then be better at their business within a different segment. In other words, take AI and use that to make your existing business in a different segment better and better than your competitors, faster, more cost efficient, right? And that to me is where there's going to be real opportunities. So folks that can recognize how AI is going to be applied and who can apply it most successfully to their existing business models to put them on steroids, so to speak, put them on a rocket ship, that's where there's going to be winners. Folks that are investing in pure AI plays are going to lose most of their money.
Yeah. And I think, you know, Zach, it's a great point. You can hear listen to what companies are telling you. It's expensive. All right. And the nice thing about Microsoft and Google and Amazon, they can make a lot of mistakes that we'll never know about. Okay. Smaller companies can't make those mistakes. So that's why it's really, really imperative to understand what your capabilities are versus your competitors and really to expound on that, push on that, and invest in that. Okay. So that you can hopefully come out ahead.
Eddie, thanks so much for joining today. It's been awesome having you.
Always a pleasure. Hopefully you'll continue your hard work in the DBA program. I'm sure you're looking forward to hopefully getting into your dissertation and finishing it up. And then someday we'll call you Dr. Zach.
I don't know if I'm going to be Dr. Ellison or Dr. Z or what I'm going to be. We'll see.
I like that.
Yeah. But anyway, great having you. I always learn a lot talking to you. Love what you're doing at the University of Florida.
Yeah.
And I'll see you in Gainesville soon.
Great. Appreciate it. Thanks, Zach.
Right. Thanks, Eddie. Go Gators.
Go Gators.